Hi friends, very good morning all of you. Welcome back to CAP classes. So we are looking at super quick revision of accounting standards which we call LMR, last minute revision, and we are in accounting standard 2. Okay. So let us not waste time and straight go to problem number 1. The company deals in 3 products A, B and C which are neither similar nor interchangeable. They are neither similar nor interchangeable. That means they are completely different. At the time of closing of its accounts for the year 2016 and 2017, the historical cost and net realizable value of the items of closing stock are determined as follows. Item A, cost 40 lakhs and net realizable value 28 lakhs. Item B, 32 lakhs, 32 lakhs. Item C, 16 lakhs, 24 lakhs. What will be the value of closing stock? Simple. You need to write the answer like this. Step 1. According to AS2, the closing inventory should be valued at the lower of cost or net realizable value on item by item basis when they are not interchangeable. So you cannot club ABC, you need to take them separately. For example, you cannot say, Pavan sir, I will add all 40, 30 to 16, I will add 28, 30 to 24 and then total historical cost X, total net realizable value Y, X or Y whichever is lower, better not allowed. You are not supposed to do it like that. So how are you supposed to do? You need to do on individual basis. So A 40, 28 whichever is lower, 28. So take 28 plus B 32, 32. So 32. C 16 or 24 whichever is lower, 16. So the value of inventory should be 76. That means do not take cost or NRV whichever is lower based on all items put together. Do it item by item. So A, cost or NRV whichever is lower. B, cost or NRV whichever is lower. C, cost or NRV whichever is lower. Like that if you do, the answer will be 76. That is what they have given. 76 is the answer. Point number 1 is over. Go to question number 2. Extend Company Limited purchased goods at cost of 40 lakhs. What is the cost? 40 lakhs. Till March 2017, 75% of the stocks were sold. So what is the value of unsold stock? Cost of unsold stock is 10 lakhs. So 40 lakhs into 25% is pending. 10 lakhs. The company wants to disclose closing stock at 10 lakhs. The expected sale value is 11 lakhs and commission at 10% on sales is payable to the agent. Advise the closing stock. So what is the cost? Cost you can say 40 lakhs into 25%, that is equal to 10 lakhs. Okay, net realizable value is 11 lakhs minus 10% sales commission you need to pay. So take calculator, 11 lakhs minus 10%. That comes to 11 lakhs minus 10%. That comes to 9.9 lakhs. 9.9 lakhs. So whichever is lower. Therefore, inventory value cannot be 10 lakhs. Inventory should be valued at cost 10 lakhs. NRV 9.9 lakhs, whichever is lower. So, inventory value is equal to 9.9 lakhs. So, the contention of management is wrong. Management said 10 lakhs, which is wrong. This problem is over. Then, problem number 3. In a production process, normal waste is 5% of input. 5,000 metric tons of input were put in process resulting in waste of 300 metric tons. Okay, cost per metric ton of input is 1,000. The entire quantity of waste is on stock at the year end. State with reference to accounting standard how will you value the inventory in this case. Okay, so what is the input? Input is 5,000. Okay, less normal loss 5%. So take this number into 5%. So good units or expected output. Expected output how much? 4,750. Expected output how much? 4,750. But actual output, they said actual loss is 300. So actual loss is 300. So abnormal loss is, actual loss minus normal loss. You can calculate abnormal loss in 2 ways. So you can do abnormal loss is equal to, you can say actual loss minus normal loss, or you can also write down abnormal loss is equal to expected output minus actual output. Expected output is 4,750, actual output is 4,700, so 50 is abnormal loss. Now, what is the cost of inventory? Cost of inventory is equal to 5,000 units you purchased at 1,000 each. That means 50 lakhs is the cost of inventory. You purchased it at 50 lakhs. Okay, now what is good units expected output? 4,750. So cost per good unit is equal to this into this. So no, divided by this. Cost per good unit is 1052. Cost per good unit is 1052. Now, so state with reference to accounting standard, how will you value the inventory in this case? Simple. So look here, cost per metric ton, they have given 1052.63. That is what we got, 1052.63. So how many units are there? You have closing stock is equal to 4,700 units. Therefore, value of inventory for the purpose of balance sheet is 4,700 into this. This is your value of inventory. That's all. Simple. Normal loss can be included in value of inventory. Abnormal loss should be charged to P&L. So abnormal loss is equal to how much? 50 units you lost. 50 into what is the cost per unit? 1052. So this abnormal loss is there, no? This should be charged to P&L. This abnormal loss should be charged to P&L. That's all. If you add this abnormal loss and value of inventory, you will get your cost of purchases. You understand? Simple. And this is very important question from exam point of view. So question number 3 is over. Question number 4. You are required to value the inventory per kg of finished goods consist of material 200, okay, labor 40, okay, direct variable overhead 20, okay, fixed production charges for the year on normal working capacity, that is 2 lakh kgs is 20 lakhs. So remember, material cost actual basis, direct labor actual basis, variable overheads actual basis, fixed overheads are to be recovered based on normal production capacity, not on the actual basis. That is what the crux of this problem is. So look here, material cost how much? 200. Then direct labor how much is given? 40. Variable overhead 20. Now fixed overhead you need to write. Fixed overhead based on normal capacity. So what is normal capacity? 20 lakh is the cost, 2 lakhs is the capacity. 20 lakhs divided by 2 lakhs, that comes to 10 rupees. So total cost per unit. Add this, so you will get total cost 270. How many units are there in your hand? 4,000 units. So quantity of closing stock. How much? 4,000 units. So inventory value is equal to, per unit if it is 270, you have 4 lakh units. What is the value of inventory? 10 lakhs 80,000. That will be your answer. So per unit 270, total 10 lakh 80,000. What did you learn in this question? In this question we learnt that the fixed overheads are to be recovered based on the normal production capacity, should not be taken on actual basis. Illustration 5. On 31st March 2017, a business firm finds that cost of partly finished unit, super, work in progress, very important, on the date is 530. So what is cost of work in progress? Write down, cost of work in progress is given 530. Okay. The unit can be finished in 2017-18 by an additional expenditure of 310. So what is additional expenditure? 310. The finished unit can be sold at 750 subject to 4% brokerage. So selling price of finished goods, how much? 750 less brokerage 4%. So take the above number into 4%, that comes to 30 rupees. So net selling price, so you can call it net realizable value also, net realizable value of finished goods. This is NRV of finished goods. But my dear friend, in the question they have given you the data of unfinished good. So from this if you subtract less further processing cost, what is further processing cost? 310 rupees. Therefore NRV of work in progress is This 410. So what is the cost of work in progress? 530. What is the NRV of work in progress? 410. So value of work in progress as per AS2 is cost or NRV, whichever is lower, that is 410. Simple. What did we learn in this question? This work in progress units are not saleable in its form and condition at present because it is unfinished good. No one will buy. So it is very difficult for you to calculate NRV of work in progress. So what we are doing, we have taken the value of finished good, selling price of finished good as the basis. From there we subtracted its, selling expenses. From there we subtracted further processing cost to calculate, to estimate what is the NRV of work in progress. That is what we have done in this question. So look here, lower of A or B, that is 410 rupees. That is what we have done here, and it is 10 minutes. Accounting standard 2 is over. So last minute revision we are doing. AS2 is over. In the next lecture I'll do AS3. Okay, keep watching CAP classes. Thank you.